Global stock markets are presenting a rather mixed picture as of June 5, 2025. We observe a landscape where optimism and caution are engaged in a delicate dance. European bourses, for instance, have shown some tentative gains in recent sessions. The Stoxx Europe 600 index has nudged slightly higher this week. This movement appears buoyed by somewhat dovish signals from the European Central Bank. There are also hopes that inflationary pressures within the Eurozone might be gradually easing. However, this upward trend is not uniform across all sectors. Underlying investor sentiment remains watchful, influenced by both local economic data and global headwinds. Across Asia, the market narrative has been notably more subdued. Major indices in the region have displayed a hesitant tone throughout the past few trading days. Japan's Nikkei 225 experienced some profit-taking after a recent rally. Meanwhile, Hong Kong's Hang Seng Index and mainland China's Shanghai Composite have traded mostly sideways. This lack of decisive upward momentum reflects a broader risk-off sentiment currently prevailing among Asian investors. They seem reluctant to make significant new commitments at this juncture. The cautious atmosphere is palpable across trading floors in Tokyo, Shanghai, and Seoul, signaling a period of consolidation. The primary driver for this widespread caution in Asian markets is the anticipation of key U.S. economic data. Specifically, the U.S. non-farm payrolls report due later this week is looming large. This jobs data is a critical indicator of the health of the American economy. It heavily influences the U.S. Federal Reserve's monetary policy stance. A strong report could reignite fears of persistent inflation and higher interest rates. Conversely, a weaker report might signal an economic slowdown. Asian economies, heavily reliant on global trade and U.S. demand, are particularly sensitive to these potential shifts. Beyond the immediate focus on U.S. data, broader global uncertainties also contribute to this cautious mood. Geopolitical tensions in various parts of the world continue to simmer. These create an environment of unpredictability for international trade and investment flows. Furthermore, ongoing debates about the trajectory of global growth add another layer of complexity. Energy price volatility also plays a role, impacting inflation expectations and corporate earnings. Investors are therefore navigating a complex web of factors, leading to the currently observed divergence and overall hesitant global market sentiment this early June. The United States economic calendar holds immense significance for global financial markets. This importance stems from the sheer size and influence of the U.S. economy. Data releases from Washington provide crucial insights into American economic health. These insights directly impact currency valuations, commodity prices, and equity markets worldwide. International investors and policymakers scrutinize these figures meticulously. They use them to gauge potential shifts in global economic currents. Therefore, upcoming U.S. data points are always highly anticipated events, capable of triggering substantial market movements across continents. This week is particularly packed with market-moving U.S. economic releases. On Tuesday, we saw the JOLTS job openings figures. These numbers provide a snapshot of labor demand within the U.S. economy. Following this, the ADP employment report was released on Wednesday. This report offers a private sector estimate of job creation, often seen as a precursor to the official government data. The main event, however, is the non-farm payrolls, NFP report, scheduled for release this Friday. This comprehensive data includes the unemployment rate, job growth numbers, and average hourly earnings, making it a vital indicator. Each of these data points offers a unique piece of the U.S. economic puzzle. The JOLTS figures help assess tightness in the labor market. A high number of openings can suggest robust demand for workers. The ADP report gives an early glimpse into employment trends, though its predictive power for NFP can vary. The non-farm payrolls report itself is the most comprehensive measure. It indicates the pace of job creation, the level of unemployment, and crucially, wage growth. Wage growth is a key factor watched by the Federal Reserve as it can fuel inflationary pressures. The implications of these releases are profound, especially for Federal Reserve policy. Stronger than expected job growth and wage inflation could prompt the Fed to maintain a hawkish stance. This might mean keeping interest rates higher for longer to combat inflation. Conversely, significantly weaker data could increase expectations for potential rate cuts later in the year. Such shifts in Fed policy expectations immediately ripple through global markets. They affect borrowing costs, investment decisions, and overall risk appetite. Investors are therefore on high alert, ready to adjust their strategies based on these crucial US figures. The cryptocurrency market continues its characteristic journey of high volatility and rapid shifts in sentiment. As of early June 2025, the overall mood in the digital asset space can be described as cautiously watchful. After a period of consolidation, many major cryptocurrencies are trading within defined ranges. Investors seem to be weighing the impact of macroeconomic news against specific developments within the crypto ecosystem. Regulatory discussions in key jurisdictions also continue to cast a long shadow. The market is searching for a clear directional catalyst, leading to choppy price action for many digital tokens. Bitcoin, the leading cryptocurrency, has seen its price hover around the $68,000 mark recently. It has faced some resistance near the $70,000 psychological level. Support, on the other hand, appears to be forming closer to $65,000. Flows into Bitcoin's spot exchange-traded funds have moderated somewhat after their initial surge earlier in the year. Macroeconomic factors, particularly expectations around US interest rates and inflation data, are significantly influencing Bitcoin's price. A more risk-on global environment tends to benefit Bitcoin, while hawkish central bank rhetoric can apply downward pressure on its valuation. Ethereum, the second-largest cryptocurrency, has shown slightly more resilience in recent weeks. Its price has been trading near $3,800. This relative strength is partly attributed to ongoing anticipation surrounding potential spot Ether ETFs in the United States. Regulatory clarity on this front could unlock significant institutional inflows, similar to what was seen with Bitcoin ETFs. Furthermore, developments related to Ethereum's network upgrades, aimed at improving scalability and efficiency, continue to be watched closely by investors. Ethereum's price action, while correlated with Bitcoin, often shows distinct responses to ecosystem-specific news and technological advancements. In the commodities market, oil prices have been a key focus. West Texas Intermediate crude is currently trading around $75 per barrel, while Brent crude is near $79 per barrel. Recent decisions by OPEC Plus to maintain existing production cuts have provided some support to prices. However, concerns about global demand, particularly from China and other major economies, are capping significant upside. Geopolitical factors in oil-producing regions also remain a wild card. Meanwhile, gold has maintained its strength, trading above $2,350 per ounce. The yellow metal continues to benefit from safe haven demand amid economic uncertainties and as a hedge against persistent inflation. The bond market serves as a crucial barometer for the health of the global economy. Yields on government bonds, in particular, reflect investor expectations regarding future inflation, economic growth, and central bank policies. Movements in bond markets often precede or confirm trends in equity markets and other asset classes. Therefore, understanding the signals emanating from fixed income instruments is vital for any comprehensive market analysis. Currently, bond markets are signaling a period of heightened uncertainty and careful recalibration of expectations by investors across the globe as we navigate mid-2025. US Treasury yields have seen some fluctuations in recent weeks. The 10-year Treasury yield, a key benchmark for global borrowing costs, is currently hovering around 4.35%. The 2-year Treasury yield, which is more sensitive to immediate Federal Reserve policy expectations, stands near 4.75%. This yield curve inversion, where shorter-term yields are higher than longer-term ones, has persisted. It traditionally signals concerns about a potential economic slowdown or recession ahead. Recent US inflation data has been mixed, leading to oscillations in yields as markets try to decipher the Fed's next moves on interest rates. Across the Atlantic, European bond markets are also navigating a complex environment. German bond yields, a benchmark for the Eurozone, have risen slightly, with the 10-year bond yield around 2.5%. This reflects the European Central Bank's cautious approach to monetary easing, even as inflation shows signs of moderating in the bloc. Peripheral European bond yields, such as those from Italy and Spain, have remained relatively stable, but are watched closely for any signs of stress. The divergence in economic performance and inflation outlooks within the Eurozone contributes to varied movements in national bond markets. In conclusion, global markets are currently characterized by a cautious and data-dependent stance. Stock markets show regional divergences, with US economic data, particularly employment figures, holding significant sway over near-term sentiment. Cryptocurrencies remain volatile, sensitive to both macro trends and sector-specific news. Commodities, especially oil and gold, are influenced by a mix of supply dynamics, demand outlooks, and geopolitical factors. Bond yields signal ongoing uncertainty about inflation and future growth. Investors should brace for continued choppiness. They must closely monitor incoming economic indicators and central bank communications to navigate these multifaceted global market conditions effectively in the weeks ahead.